Hello friends, hope you are all doing well. As you would be aware that recently the UAE government has issued a corporate tax law, that is a federal decree law number 47 of 2022 for taxation of corporation businesses, which shall be effective from the financial year starting post 1st June 2023. We have prepared this deck which encapsulates the key tax provisions discussing the international tax and transfer pricing aspects. Hope you find this presentation informative. Also need to mention that we have tried our level best to capture all the aspects to the extent available in the provisions, as also at certain places we have referred to the FAQs which has been also issued by the UAE government. Hope you enjoy learning in this Christmas holidays. So friends, we have listed here the topics which we shall be discussing in the forthcoming slides. As you all are aware that the law has been just framed and we understand that the same shall mature as and when the time passes by. However, it needs to be appreciated that the UAE government has considered all the key aspects which are currently prevalent in the global taxation scenario. Also, we wish to highlight that there are certain topics such as general anti-abuse rules, taxability under free zones, qualifying investment funds, etc. have not been covered in this deck, owing to the fact that each topic is itself a separate area for discussions. Starting with the first, corporate tax is the tax imposed by decree law on juridical persons and business income. As you can see that the corporate tax is levied on juridical taxpayers, while in case of individual taxpayers, it is only levied when they are engaged in business or business activity. Further, the tax rate at the rate of 9% shall be levied on taxable income exceeding AED 375,000, that is approx USD 102,000. Moving ahead, guys, the decree law also defines a resident and non-resident person. The key thing to watch out here is that even if a juridical person is incorporated outside UAE, however, the same is being effectively managed and controlled in UAE, then the said person shall be considered as a resident person. Further, a non-resident person is the one who has permanent establishment in UAE and or who derives a state source income or has the nexus in UAE. All these aspects have been explained in the coming slides. Now moving ahead, we have also captured the provisions pertaining to the corporate tax base on this page. Corporate tax base pertains to the taxation basis, the residential status of the respective taxpayer. As you can see that a resident person is taxed on its UAE income as also on the incomes earned outside UAE. Further, in the context of non-resident, the taxable income that is attributable to the permanent establishment shall be subject to corporate tax in UAE. The CT law also introduces the concept of state source income, that is, the income will be considered to be sourced from the UAE if the income is derived from a UAE resident or the income is attributed to a permanent establishment in the UAE of a non-UAE resident, or the income is derived from the activities performed, assets located, capital invested, rights used or services performed or benefited from in the UAE. It is also worthwhile to mention that withholding tax has been kept currently at 0% on all the payments. Moving further, guys, it is worthwhile to note that the definition of permanent establishment in the UAE CT law has been designed on the basis of definition provided under Article 5 of the OECD Model Tax Convention and as per the position adopted by the UAE in OECD's MLI project. This specifically allows the foreign persons to use the relevant commentary of Article 5 of the OECD Model Tax Convention when assessing whether they have a permanent establishment or not in the UAE. Further, here we have listed certain key aspects on PE which are emanating from the CT law. As stated earlier, it can be clearly inferred that UAE has designed the PE provisions in the CT law considering the Model Tax Convention and MLI. We have highlighted all the relevant tests which are required to be made before arriving or concluding the existence of foreign persons PE in UAE. Moving ahead, guys, the corporate tax law provides for certain restrictions on the deductibility of interest expenditure to discourage the excessive debt financing and to ensure that debt financing used or arising as a result of certain specific intragroup transactions will only be deductible if there is a valid commercial reason for obtaining the loan. For the same, general interest deduction limitation and specific interest deduction limitation rules have been enacted under the law. It is worthwhile to note that where a loan is obtained from a related party and is used to finance income that is exempt from CT, the interest on the related party loan will not be deductible unless the taxpayer can demonstrate that the main purpose of obtaining the loan and carrying out the transaction is not to gain a CT advantage. The corporate tax law also introduces the concept of unincorporated partnerships. The corporate tax law makes a distinction between unincorporated and incorporated partnerships. Basically, the unincorporated partnership has been defined as the relationship established by contract between two persons or more persons. The main thing to understand here is that the unincorporated partnerships are treated as transparent for UAE CT purposes. Further, the partners can also make an application for treating the unincorporated partnership as a taxable person. The law also has enacted the provisions for foreign partnerships to be treated as unincorporated partnerships. Now we move on to the UAE transfer pricing provisions. The UAE TP provisions are applicable on UAE businesses that have transaction with related parties and connected persons. Further, similar to India TP regulations, six methods have been provided under the UAE TP law to determine the arm's length price. The provisions also provides guidance on selection of most appropriate method, as also it clearly provides that in case a foreign competent authority makes an adjustment to a transaction or arrangement involving a taxable person to meet the arm's length standard, such taxable person can also make an application to the authority to make a corresponding adjustment to its taxable income. Moving ahead, the terms related parties and control have been defined well under these provisions. As you can see, all direct or indirect relationships have been duly covered under the said definitions. Further, the ownership percentage for determining the relationship between the parties has been kept 50% or above, while under the India TP provisions the same is 26%. Also, the key thing is that the provisions does clearly defines the term control, which is actually a missing aspect under the present India TP provisions. So friends, we have also covered the definition of connected persons as they are different from related parties as we discussed in the earlier slide. It can be seen that the TP documentation requirements does include preparing of local file as also master file. We believe that the detailed list of information to be maintained shall be issued in the forthcoming period. It can be also inferred from the FAQs that the businesses that claim small business relief will not have to comply with the transfer pricing documentation rules. Further, the provisions also provide for APA arrangements. So guys, at last we have also tried to cover the other provisions which were relevant in the area of international tax and transfer pricing. Particularly focusing on BEPS Pillar 2, we can understand that the same shall be adopted by the UAE government in the forthcoming period. So this was all friends. Hope you liked the video. Thanks for watching this. Hope this was informative and worth listening to. We will keep sharing similar updates in the forthcoming period. We would be pleased to receive your feedbacks on this video. Thanks again and happy holidays.